So now we'll kind of launch in. Hi, everybody, and many thanks for joining us today for our natural resource webinar, Tax Considerations for Your International Business. I'm Joseph Archer. I'm a partner here at PKF Littlejohn and head up our natural resource team. And before I introduce our speakers, I just want to make sure we cover a few key housekeeping points. Firstly, if you have any questions during the webinar, you can submit them through the Q&A widget, which is at the bottom of your screen. We will try to answer as many of these questions as possible at the end of the webinar. But if your question do need a fuller answer, we run out of time, we will get back to you later via email. And also don't ever hesitate just to give any one of us a call so we can respond to your needs. Please do know that we do capture all the questions in that widget and we will respond on them. An on-demand version of the webinar will be available shortly, and we will circulate the recording via email as well. And also online, there is obviously both our tax considerations handbook as well as our accounting guide to the natural resource sector. This webinar is designed to help international natural resource groups explore the sector-specific tax regulations and also have an awareness of what HMRC will be expecting from you. We consider this to be very topical given the complex nature of the cross-border taxes that are involved in this sector due to very much the way the sector is obviously made up and where you will do your business. Our speakers will be discussing key issues you might need to consider before embarking on during your overseas venture, and so you can seek the right advice at the correct time. It's very much designed to raise and to make you think about the questions you need to ask at what stage of your journey. Today, we'll be specifically exploring corporate and withholding tax, transfer pricing and VAT across all stages of a natural resources business lifecycle. I will shortly pass on to Chris Riley, who will introduce things in more detail and the speakers. But just before I do that, I do just want to remind everyone about our Capital Markets Summer Drinks, which are tomorrow night in Marylebone. If anyone hasn't got an invite or would like to come, I would say please do reach out to us and we can obviously direct you to the relevant location. I can promise you it will be a fun and good evening for you. I'll now just pass over to Chris just to introduce our speakers and also go into more detail in respect of the content of this webinar. Thank you.
Thanks, Joseph. As Joseph introduced me, I'm Chris Riley. I'm head of tax at PKF Littlejohn. I've been with the firm for 18 years now, specialising in corporate tax throughout that time. And particularly in recent years, we have significantly expanded our tax team across all key taxes in the UK in order to better service our clients, many of which have got a multinational focus. And of course, that's ever relevant in the natural resources space. Natural resources perspective, respect of tax matters, we provide compliance services, we provide tax advisory services, always considering all the key areas of tax and not on a standalone basis, but also we work to a significant degree with Joseph and the other partners in the capital markets team in respect of audit support for tax provisions, in also respect of listing matters, due diligence, etc. As I say, tax considerations on a multinational basis, natural resources rarely consider a single area of tax. When a business is multinational, you have transactions between the parent and the subsidiary or between subsidiaries. You're going to have an income item in one entity, an expense item in another entity. But it's fundamental that those numbers are calculated correctly to reflect the true economic value on an arm's length basis. And that's where FARM comes in from a transfer pricing perspective. Having had a transaction, there is a question of what taxes is it subject to? Is it subject to VAT? Where is it subject to VAT? What are the recording requirements? And of course, from a corporation tax perspective, is that expense deductible? Is that income taxable? Natural resources businesses as well have a unique life cycle, which doesn't necessarily apply to other multinational businesses. We have the exploration phase, moving into development, into production, and ultimately decommissioning. At each of those stages, there are different tax considerations, and the three panelists today are going to run through those in order to consider the various tax implications. So let me introduce the panelists that I've talked about previously. Ravish is a director in our corporate tax team, having joined us earlier this year. He's got deep experience in corporate tax compliance and advisory matters on a multinational basis, working with some extremely large multinational businesses in previous firms I can't mention, obviously, but it's suffice to say, some very large businesses and some great experience that he's brought to the team. Byron is a transfer pricing specialist who's worked not just in the UK, but all around the world, dealing with multinational businesses, considering transfer pricing outcomes, not just the values that are relevant from a transfer pricing perspective, but also the recording and documentation requirements that differ between jurisdictions. Finally, Mark, last but not least, I should say, Mark, who is head of indirect taxes, which obviously in the UK is to a significant extent concerns VAT, but also includes matters such as customs duties and other relevant indirect taxes, such as landfill taxes. So enough for me. I believe that Rav is going to start off going through the life cycle of the natural resources business.
Thanks, Chris. Morning, all. So most businesses we see in the UK has UK parent co with overseas subsidiaries. Now, complex nature of these cross-border structures mean we should be thinking about tax during financing, operating, and profit extraction. There are tax issues as well as tax opportunities we should be thinking about. Why does the flow of funds happen? There is a need to apply transfer pricing to fund corporate level costs. These are head office costs, maybe, to reduce cash holdings in subsidiaries, maybe due to economic risks, or maybe due to a jurisdiction has political instability, etc. Now, it's key to think about how do we invest this? What happens during repayment of investments? We see two routes, loan, share capital. We see a lot of our firm of clients going through loan option. A repayment of loan doesn't itself incur any tax, but interest charged on these loans incur tax, so it has tax obligations. Share capital, there are legal complexities while choosing this route. There are also capital controls in place, which makes repayment of share capital very hard. Some jurisdictions have investment incentives, and what route you choose also depends on some of the restrictions on these investment incentives. So there is a lot to think about. So I'd like to mention dividends here. We see a lot of companies, sending dividends to the parent co. Sometimes what happens, we need to look at, are there any exemptions applied in any of the jurisdictions? For example, in the UK, we scrapped dividends, taxes on dividends in 1998. So these may incur some costs. Good news, there are, as I mentioned, there are tax opportunities, which means there are tax treaties between different jurisdictions, which we can play to our advantage. Next slide, please. So withholding tax is actually a mechanism by which you collect taxes. In the UK, these taxes are based on OECD Model Convention. There are various articles in these convention. So Article 10 talks about dividends. Article 11 talks about interest. Article 12 talks about royalties. Royalties may be on IPs or patents. In natural resources, we see on management fees, professional fees. So we have withholding taxes. After VAT is charged, there is withholding tax implications as well. What is a tax treaty? So this is a treaty between two countries. So UK parent co has a tax treaty with the overseas parent co. It has potentially two impacts. One, it can set a potential rate. So these rate may be lower to the basic income tax rate you charge, or it can also set parameters of the transaction. So it's not just the rate which tax treaty will set, it also the scope it can define. There are various questions we should be asking about during considering treaties. Are there any specific conditions in these articles which need to be met in order to apply these reduced rates? Are there any anti-avoidance provisions which will prevent these withholding taxes?
Thank you, Rav. So I'd like to provide some context for transfer pricing in the natural resources sector. So as a recap, well, what is transfer pricing? Well, TP rules essentially require that internal transactions between multinationals across border are priced at arm's length. That means what you would expect to prevail in third-party arrangements. Mispricing, that can lead to tax audits, disputes, tax adjustments, penalties, and fines. Clearly, it's a complex sector with both domestic and cross-border implications. So making sure you're compliant with those rules is important. Understanding value chains is also important. So as you can see in the slide, value chains essentially informs how we look at businesses for transfer pricing. So you can see upstream, midstream, and downstream activities. You may be engaged in some or many of these across different markets. Key question for TP is, well, what are the activities taking place in country, and to what extent are those being driven or supported by other services and support coming from another jurisdiction? In a UK headquartered scenario, clearly we might have management and support services, we might have marketing, financing, technical services, or insurance. All of these are intra-group cross-border support that should be priced at arm's length. It's also important to remember that given the highly regulated and tax transparent environment we're now in, there's clear documentation requirements for multinationals. So transfer pricing documentation, master file, local files, other tax reporting forms are just a feature of the industry. Risk of non-compliance clearly is high, and the penalties are onerous. What's the key point? Clearly, in your business, you should be thinking about, well, what are the key activities in country? Have I critically mapped what's driving value cross-border, and what are the flows? And are they essentially being defended and supportable on any review?
Thanks for that. In terms of VAT, the key question is there a blockage in the pipe? That is what we have on screen here. In order to recover input VAT, you need some sales and some output VAT, ideally. We'll come to that later. We frequently see companies that have registered for VAT file VAT returns and recover VAT on expenditure and say, there's no problem, I'm getting the money back from HMRC. And then they get a surprise VAT inspection that gives them a 4-year bill, clawing back the VAT they've reclaimed. And it's all down to this key point: are there sales? Is there something being sold? Interest on loans is a normal example we see in this context, or management services. Without that, those sales, you don't get to reclaim input VAT, and that's pretty much the same across all territories that have a VAT system.
Right. As Joe mentioned, the main purpose of this, like talking about the different stages of natural resources. So setup. So what happens when you set up a parent co and you set up a subsidiary co? And then the next stage is extraction and production. So where you actually extract the natural resources, there are costs incurring, mining costs, etc. What happens to those? Commercialization, when subs actually starts making money, and then flow of this money from subs to the parent co. What are the tax implications? What are TP implications and VAT implications? Shutdown stage, which is shutdown of the subs itself or decommissioning obligations, etc. Next slide, please. Right. So this is a setup stage. As I mentioned before, it's key how you structure this, because a lot of tax implications in the future stages will actually depends on how the overall structure is. So there is a loans and capital, each has its own tax implications. So a lot to be thinking about there. What happens to the costs? You would incur any initial setup costs, legal professional fees costs. Are these tax deductible, or are these tax you need to add back? So another key important aspect to consider here is making sure that the overseas sub is not considered as a UK resident. So what I mean by that is making sure like the control and the management actually happens in the overseas subs and not UK. So we'll come back on that in the later slide as well.
Thank you, Rav. So clearly, typically when at setup phase, we have an advance of funds coming down to key operating markets to essentially fund the initial activities in country, typically by loan. And currently, we're clearly in a very high interest rate environment. I commonly see groups lending interest-free, and clearly that can be a serious issue for TP, because that's an easy target for tax authorities to adjust. So what are the options? Well, you can look at deferred interest payments. You can look at clearly equity financing, but it's important in each case to understand that whichever is the chosen form of the finance does have an impact, and it has a flow through in terms of later phases in the structure.
On the VAT side, the parent companies in the UK, you frequently see them incurring significant amounts of UK VAT on legal and professional fees, maybe to do with the floats and ongoing arrangements as well. And one of the first things we look at is, was it correct for UK VAT to be charged? And we've seen this on many occasions that it's just not. The reason being, a holding company tends not to have much in the way of human and technical resources. It has some intangible assets, maybe owns some shares in subsidiaries, maybe has a loan out to them, interest-bearing or otherwise. And its employees are effectively its directors. And then we look at that a bit closer and we go, well, sometimes the directors aren't even residents in the UK. They're actually residents of the territories where the subsidiaries are, in Africa or Australia, wherever. And when we see that situation, HMRC's guidance is clear. The UK advisors should not be charging UK VAT because there is no customer in the UK as far as they're concerned. But if we take the example where we do have a parent company that does have some substance here, one or more UK directors, or the directors are meeting physically in the UK, coming from overseas to have board meetings here, or there is a CFO, etc., employed here, then we do have substance, and it's right that UK VAT is charged on those fees. Then we need to look at, is it right that there is a recovery of VAT and a VAT registration? Just because HMRC have registered for VAT, you've recovered some VAT, does not mean that they won't actually look at that closer at a later date and go, was that correct? The thing we need to see is some loans that are charging interest that can be rolled up, but it's got to definitely be payable, and ideally some management services for use of people in the UK. The loans made to the overseas subsidiaries can be used to pay those management services. There are so many VAT cases on this where people have tried and failed, and we've basically got a template now from case law precedent and HMRC guidance telling us what we need to do, and we should not ignore that.
Extraction and production stage. From corporate tax perspective, this is where the cost actually incurs. So subsidiary will incur costs. There is a function from parent co to subsidiaries, and there are charges from subsidiaries to parent co for these functions, which should be at arm's length basis. Now, these charges is a win-win. So in the subsidiaries, you can have a tax relief for these charges, and in the parent co, this will reduce the amount of profits you would be taxing. So it's a win-win. You can also have an alternative structures to this, which will come back in the future slides.
So clearly now in extraction and production phase, we see significant spend often accumulating in country. So there's clear losses coming through, cash flows yet to generate. And the key question becomes, are those entities actually bearing the market risk? Or to what extent is the UK, through the provision of the financing, services, IP, assets, is that the entity taking risk? That matters because the transfer pricing policy set at the extraction and production phase will often be a template for how later business structure is seen and taxable. Key point, just bear in mind, as you provide any of these flows, you're pricing them at arm's length, and you've got a clear plan of how you're going to be able to defend and document them.
VAT is not just in the UK. Many countries around the world, in Africa, Australia, Canada, wherever things are in the ground, they have VAT systems. The USA doesn't, probably never will, but there are lots of them around the world. And while they follow similar principles to that you see in the UK and in Europe, there are differences. One of the key ones sometimes is that you don't get your input VAT back when you pay for expenditure like you do in the UK. You have to wait until you've got some sales VAT to set it off against. So, for example, that can be the case in Ghana, Nigeria, and Uganda, can be in other places as well. And that's a risk mitigation mechanism by tax authorities to make sure they don't lose out on VAT. And again, that's having to think about how I've got to fund that VAT, maybe with more loans with interest being charged to these subsidiaries. And I'll be waiting to get that money back and hopefully getting it back at a later date. And the issues around getting that money back can be exacerbated where you've got shortages of cash at in the country of concern. It's not just the UK that has a deficit.
Commercialization, the stage where subs actually starts making money and these funds will flow from subs to the parent co. A lot to think about here. What happens to withholding taxes on interest, royalties, and dividends? Are there any dividend exemptions? Is there tax treaty helps reducing any of the rates? For example, in UK, the tax rate is 20% on the item. Now, some of the examples I could think is like Nigeria, you can reduce the tax rate to 12.5% on royalties and interest if you have a treaty between these two. And the treaty between UK and the France, there is no withholding taxes on interest and royalties. Like say Saudi Arabia, the dividend is like taxed at 5% rather than 20%. So there is a lot of corporate tax implications to be thinking about.
So clearly now commercialization, we often have significant income and profit generating in the operating markets. And typically those markets are subject to high rates of tax. These are asset-rich countries, therefore clearly tax authorities, this is the point at which essentially they bite. They want access and they want transparency on what are the profits and how are they being priced and taxed. Clearly from the UK perspective, a key question now becomes, well, to get those entities to profit stage, what was the key support provided from the UK? So all the stuff we talked about, management fees, financing, technical, insurance, whatever the support is, was that priced appropriately? And as in this part of the structure, that becomes very evident because if you haven't been pricing them earlier on, and you're now looking to push charges down, essentially make sure you've got a proper allocation of income and profit back in the UK, that's where challenges come. So again, just bear in mind, as you set up structures, you've thought about it in the early stage because it often has an impact later when clearly tax efficiency also becomes a priority.
In terms of local VAT or similar regimes in the territories where the production's actually happening, now we're moving into the paying phase. So maybe it's time to set off that input VAT recovery that we've had earlier. And if things are going very well, then there's lots of payments of VAT potentially to the local tax authorities, depending on what's being sold, whether it's an exported service or good or a local sale of goods or services. And this is the time to make sure you pay everything you need to pay on time. Again, local rules may not be the same as the UK. You might think that's payable when you invoice. It might not. It might be payable when the contract's signed, even though you haven't invoiced or got paid yet. You just don't know. You need to check because the penalties in these territories can be big. That's how you raise revenue. The UK doesn't tend to levy penalties for VAT errors very often, and usually they're not that big. Maybe that'll change in the future under a new government, but right now it's not that. It's pretty lenient in the UK, or the territories less so.
Shutdown stage. In the UK, tax relief is not given on decommissioning provisions in the financial statements. The tax relief is actually given when the expenditure is incurred. So it's key to note that. Another aspect is there are 100% capital allowances available on some of the decommissioning assets. So that's another thing to note.
So clearly when income and profit is now falling and costs again are building up in a decommissioning phase, key question becomes who should be bearing those costs? Are they properly attributable entirely to the operating markets? Or to what extent should they actually be borne by the UK if that's the entrepreneur in the structure and that's been the one driving the business?
In terms of VAT in the UK, if you cease trading and you do register from VAT and then you have post-cessation expenditure, you can still claim the VAT back. There's a form for it, and you may be able to convince HMRC to keep your VAT registration live. Overseas territories, again, this is where things may differ significantly from the UK. So being aware of what you need to do to continue to be able to reclaim VAT on post-cessation expenditure after the trading has ceased. As I mentioned before, there's difficulties where input VAT is held as a credit waiting for output VAT later to set it off against. This may be an issue in those overseas territories.
As I mentioned before, you can have tax structures so that you can take it as a tax advantage. So in here, what we have is a Dubai Co. So sales services are provided by the Dubai Co. So one thing to note is services need not to be performed at parent co and the subsidiaries. There may be another entity which can perform some of the services. The key aspect here is to note that there should be a substance which is boots on ground, which means where the place of effective management actually takes place, where the day-to-day activity takes place. So that's one thing to consider.
So again, I'd like to just provide a bit more context for international expansion in the natural resources sector. So clearly we have headquarter UK company. Often the key question is, well, what if we set up an international hub? The UK may in substance already be that, but certainly you could look at other markets. UK, Ireland, classic hubs for Europe, Middle East, look at Dubai, Asia Pacific, Singapore stands out. Why are these locations important? Because they are essentially attracting businesses, especially multinationals, as magnets for profit in the region and with access to talent pools, proximity to customers, and other means to essentially grow and drive the business forward. What about the tax implications? Well, clearly, if you set up an entity in these markets, you need to have appropriate substance. You need to think about what is then potential exit tax. Is there potential restructuring in the supply chain? And what are the new flows now going to be? If you put it in the context of the operating market, what we often see are, for example, you might have an offtake agreement for the finished products. You might have other flows going through. And the key question becomes, well, what's the relative value contribution between, say, the UK, international hub, and those operating markets? Clearly, if the hub is now driving income and profitability, you'd expect there to be significant income and profits landing in that jurisdiction. It's important to remember these are international structures. They're very common in the market. And actually, if you haven't thought about it, it's perhaps time to do so, because this is how international tax structuring works.
Going back to the slide before, from a VAT perspective, just taking Dubai, for example, there is a VAT regime in Dubai now. This is one of those new territories that has adopted VAT. It depends very much whether the company is providing services or goods from a VAT perspective. If it's supplying services, sales agency, collection services, or royalty income streams, that kind of service, then the VAT rules in most countries tend to look at where are you. So if there's substance there in Dubai, saying, well, I need to charge Dubai VAT if I'm charging a Dubai customer, and if it's overseas, I probably won't charge any VAT. The difficulty comes if the Dubai company is interposing itself in sales of goods. So buying the goods from the local subsidiaries and then selling the goods to the end customers. That tends to bring the Dubai company into the VAT regime of the other countries. That's such a general principle of VAT. Where the goods are bought and sold is where the VAT happens, and it doesn't so much matter where the buyers and sellers are located. That's the reason, for example, when you buy goods from Amazon and you look at the package and it says Amazon Luxembourg on it, they have a UK VAT registration because they are buying and selling goods that are located in the UK at the time of that purchase and sale.
Thank you very much, guys. we have left time for questions, which is a good thing because we have got some questions that have been raised in the Q&A box. I think first question, I think I'll direct this to you in the first instance, Mark. Obviously, we've talked through here the life cycle of the natural resources business, but one attendee has raised, well, what if we don't go through the full life cycle? What if the plan was always to prove the asset and then sell it to a third party? How would that change our analysis and our advice?
Thanks for that, Chris. VAT is always about intention and how you evidence that, not just what you actually do. And then you can reflect on, did that match my original intention? So if the original intention was to do everything we've just talked about and then it changed, then you would have to relook at all of that recovery I've had to date. Is it going to relate to a share sale now? Now, a share sale is something for VAT. It's VAT-free. And if it's a sale of shares to a UK customer, that stops VAT recovery on associated expenditure. So that can be an issue. If it's a sale of shares to a non-UK buyer, then that's fine. You get full recovery. If that was always the intention to do that, it's having that evidenced. Frequently speak to clients and they tell you this story and you go, I wish you'd evidenced that in your board meeting minutes and your share prospectus, your accounts, etc. Tax authority officers hear stories all the time. It's much better for them to read the story in a third-party document, for want of a better word.
I completely agree on that, Mark. The prospectus is a really, really valuable piece of information in an argument with HMRC, unless it says the thing you didn't want it to say in the first place. And Rav, obviously, if we're in a sales situation, some different considerations there.
Yeah, so this has both local tax implications as well as the parent core. So these are likely to trigger capital gains. However, there are various exemptions which are available, like both locally as well as in the UK. So in the UK, I can think about substantial shareholding exemption you can get. So yeah, like take advice when things like this happen and see, how it structures. Yeah.
So transfer pricing is very much focused on people and substance. So key question is, well, who was performing the key value driving activities? Were they happening with people in country, so boots on the ground, or actually were there key executives making decisions in terms of where to explore, the kind of processes and surveys that are going to get carried out, who's providing the expertise, and the decision to sell? So all of those things ought to be properly priced. Clearly, when you have a sale, there's a cash flow that comes into one entity, but it's not properly fully entitled to that, clearly, if there's been support coming from around the group. And again, if you don't allocate properly, you can have a mismatch in income and profits, which means your tax reporting, and effectively that's the risk, and also can be an efficiency issue as well.
Cool. Fine, while you're unmuted, we've just had another comment, another question in the Q&A box, which is looking at the UK transfer pricing exemptions for small and medium-sized entities, and can a UK parent use that to charge 0% interest in respect to their group funding?
Okay, good question. So I often work with clients who raise that point, and it's not as simple as saying because you're an SME, you're exempt from transfer pricing, because the UK exemption is actually quite nuanced. Firstly, if you're medium-sized, it's not a blanket exemption. Actually, HMRC has the discretion to remove that and can subject you fully to transfer pricing rules. The other key point is you're just on one side of the transaction. Remember, the counterparty is your key operating, and in those markets, especially if you're dealing with developing countries, they typically have no such exemption, or they have very low thresholds at which transfer pricing will bite. Because we're dealing now, remember, with natural resources, so these are asset-rich countries, they're going to protect their tax base. So sometimes I'm working with clients where they think they can rely on the SME exemption in the UK, but actually that's not the key issue. The issue is actually the counterparty in the developing market or wherever they've got those business operations, where transfer pricing kicks in, and essentially an adjustment can be made. So all the things we talked about earlier, interest-free loans, services not being charged properly, those are triggers for essentially tax authority disputes.
Thanks.
I was going to say interest-free loans are a problem for me. An interest-free loan and share capital, that's not sales for that purposes. So if we're doing interest-free loans, I need something in its place to give me a sale. This is where we see management services typically, or back office supports, or whatever it needs to be. So that can be problematic for me on input VAT recovery in the UK.
I think it's fair to say, Mark, that you may have management services agreements in place, but they're always potentially subject to challenge by HMRC. So by having an interest-bearing loan there, that's a second line of defence that we actually have some supplies.
Absolutely.
Moving to the other end of the spectrum, there was a question about small and medium exemptions. Rav, a lot of natural resources companies operating in overseas developing jurisdictions, I can think of a few in, say, sub-Saharan Africa, may have some very, very generous corporate tax incentives, such as corporate tax-free periods of 5-7 years post commencement of production. Obviously, for larger companies, we have a global minimum tax rate now. And can you just give a couple of minutes of how that might overlap?
Yeah. So in, I think, December 21, OECD released Pillar 2 model rules. So a lot of activity is happening on Pillar 2 in the market. Now, so what happens, these are for businesses over 750 million euros for the last 2 out of 4 consecutive years. So you need to go back to the last 4 years and see if your revenues are more than 750 million in the last 2 of the 4 years, then you'll be subjected to this. This is based on the consolidated revenues, not just the entity level. So what you actually factor in your consolidation accounts. Now, this is based on ETR, effective tax rate. So 15% is what they've set, the minimum targets. Like if your jurisdiction is less than 15%, then you are subjected to that 15% tax. Now, we know a lot of, jurisdictions have not implemented Pillar 2. So in that, generally, it's an ultimate parent who pays this tax, but it comes to the intermediate holding company if there is a jurisdiction which is not implemented any of the Pillar 2 rules. So yeah, like these incentives, what it does is it makes your ETR less than 15%. So then you are subjected to that additional tax.
Fine, I'm sure you've got some thoughts.
Yeah. So remember, for transfer pricing, we're always thinking about individual country perspective. So you could look at the operating markets and say, well, there's a tax incentive, so everything's fine. But what about the counterparty? So as we spoke about earlier, if you're dealing with the UK or any other jurisdiction where there's a provision, those services and that provision needs to be priced at arm's length, because if it's not, that means it's not getting income and profit to which it's entitled. And that means an adjustment potentially in the UK. That could then be a one-sided adjustment, which clearly means double tax. And it also means you're now exposed to further scrutiny because there's a clear gap in your TP structure. The other thing to remember, of course, is also incentives do have a life. They do expire. And when they do, clearly a key issue can then become, well, should we be charging for services? And the question becomes, well, you've not been charging it for the prior periods. And so now all of a sudden you're now trying to charge for something, and that runs into issues because, well, what's really changed in the business, which now supports a change. And then again, there's a look back to that, and that can mean a dispute going back multiple years. So like I say, it feels like a very easy way out, but it's anything but. And it's important to make sure you've got a clear strategy right from the get-go in terms of how the TP will play out in different phases and different scenarios, such as including incentives.
Oh, thank you. Fine. Last question, and just to prove how the transfer pricing sits in the middle in respect to tax matters. You mentioned in your background on transfer pricing, master file and local file. For people who've not previously been exposed to transfer pricing requirements, can you give background on that?
Sure. So OECD, clearly the UK is a member. Most countries around the world subscribe to OECD guidelines, or we also have the United Nations Transfer Pricing Manual, and that's very much focused on developing markets. So what are these master file, local file requirements? Essentially, it's about tax transparency. There's been a lot of concern in the past around BEPS, so base erosion and profit shifting. It's the belief in, certainly in these natural resource rich countries, that multinationals are entering into structures where they're essentially stripping income and profits from country to lower tax jurisdictions. So whether that's true or not, often there's a legal obligation to prepare a master file or a local file or have some other documentation to clearly support any cross-border flows are being priced at arm's length. It's also important to remember that when you come to file your tax return in country, these rules can bite. In other words, there's an expectation or an obligation that you're compliant. There's also now common in many markets, they have what's called local cross-border transaction reporting forms, which means you have to specifically identify what are the cross-border transactions that took place. So the tax authority can see what the outflows are from country, let's say to the UK or elsewhere. And again, the idea being that if they are significant, they can clearly start asking questions about, well, how have you priced those? Because that's essentially taking income and profit out of the country to an offshore jurisdiction. So, short answer, master file, local file, other transfer pricing documentation is important. It's evidencing the fact that you've got a robust policy. And so clearly you should have that policy, because otherwise the documentation falls down very quickly.
Cool, thank you. We've covered the questions that have been raised in the Q&A box so far. So I'll move to close now. I mean, obviously, thanks Farhan, Mark, Ravish, all very much UK tax specialists, real deep knowledge of the UK tax systems in which they operate. And I'm just going to ask them in a second to give their 3 key takeaways that they think everybody listening should take forward in their business, in their specialist area. But of course, we are UK tax specialists, and the UK has got the longest tax legislation in the world. It's difficult enough keeping up with that without expecting the 4 of us to understand all of the overseas jurisdictions' tax requirements. And that's where the PKF Global Network comes in for us, and is really valuable in helping us service multinational business, and particularly natural resources space. Where we've got 214 member firms in over 150 countries worldwide. And within those offices in those overseas jurisdictions, we've got that same depth of knowledge as it applies to the local markets. So if you do have questions, not just from a UK perspective, but also where you're actually operating, we should be able to find an advisor to give you that same level of advice as we can give here. So as I mentioned, 3 key takeaways, a couple of minutes each. Farhan, you've spoken a lot, past couple of questions. So I'll throw to Mark, if I may, as what you think people should take away.
First key takeaway is don't assume overseas VAT regimes are just like the UK. There's so many differences out there. You need to find out what's going on the ground, and it may have changed from what you understood a few years ago. Guess what? VAT law changes a lot because it's a big revenue driver. Number 2, don't just assume you've been VAT registered and you've been reclaiming some VAT through VAT returns that HMRC are okay with that. One of the things we've heard a lot from the political parties, pretty much all of them, is there's all this evasion, avoidance, missing out on VAT and income tax. This is how it happens. People just get registered and start getting VAT refunds and don't get scrutinised. What we have seen, though, is HMRC after the pandemic getting their act together. How many clients have recently just had a 4-year VAT inspection started? Because guess what? They can do it remotely now. They've seen the advantages of hybrid working, and it's very efficient rather than turning up on site. And lots of clients are going, where did this come from? I haven't heard from HMRC for 10 years. And this is what's happening. They're asking for management services agreements and things like that, and not being met with a good answer. Don't want to hear the story. Where's the supporting documentation? Don't care. Here's your assessment. Sort it out in the courts. That's not great. I think the So the last key takeaway is, if you are thinking of any transactions, I'm going to maybe sell the business or do something else in future, you need to think of this stuff now. Protect yourself. Somebody like me will pick it apart in a heartbeat if it's not there, saying there's a huge risk that a tax authority in the UK or otherwise could have a go at that if they saw it. So just keeping your fingers crossed that you don't get inspected is not a tactic. You need to have stuff in place ready for if you are inspected.
Yeah, and yeah, the due diligence exercise, Mark, is just as thorough, if not more so, than the VAT inspection. And so, you know, those risks may well come one day. Rav, from a corporate tax perspective.
There are tax implications on how do you structure your business, how do you structure your funding. There are withholding tax implications on interest, dividends, royalties, which is like we see like management and professional fees, management charges and professional fees. Also, I would think about, there are treaties which you can take to your advantage. So we have been assisting a lot of clients where they want to enter into a specific structure and they want to know about how the treaty works and how can we assist them on those treaties. Third thing, there are alternative structures available. Remember, services need not be performed by just parent co and subsidiaries. You can also have like other entities in structure, but yeah, boots on ground is key. Yeah.
Cool. Thank you very much, Rav. And finally, Fine.
So I think first key takeaway, just make sure you actually have a transfer pricing framework. So you've actually thought about, okay, what are my cross-border flows? How are they being priced? And are they supportable? Second key takeaway, clearly we're working in a very dynamic market. You know, there's a lot of volatility, supply chains change, prices change in the market, people move around quite often from headquarter to local market. It's very dynamic. And those policies can quickly start to become creaky, or actually they just look very much out of date if the pricing doesn't match those differences. Again, just refresh and review at interval to make sure you haven't got a disconnect, because if you get it wrong, it means you're not only not compliant, you're probably paying too much tax as well. Third key takeaway is make sure you've got proper support and documentation. It sounds like it's just a compliance obligation, but actually it's designed to ensure that you've actually done the transfer pricing analysis, because it's a look back to what was happening during the year. As you come to file your tax returns, you can evidence the fact that you're compliant. And if it's the first time you're doing it, again, just go back to that initial question. What's my policy? How do I fix it so that when I do come to document, I know I can defend an audit?
Thank you, Fine. Thanks, everybody. I never want to be the last person to speak, so Joseph, I'll leave the final words to you.
Thanks so much, Chris, and thanks so much to all the panelists. I do hope that you found this very useful. And if you've got any other questions or things that may pop into your head after the event, don't hesitate to contact any of them. I think all their email addresses and contact details are on the slideshow, which will, as I stated earlier, will be made available. And again, to you all, I do hope you enjoyed it, and I hope to see many of you tomorrow night in Marylebone. So all the very best and enjoy the sunshine. Take care. Bye-bye.